For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, let's manage your financial future. What do you say? Once again, Johnny Dean, your podcast host. 5 things. Here we go again. 5 things. What is it this week you did not know about your 401k? First, I'll welcome Professor Rick Plum, certified financial planner, professional, and accredited wealth management advisor. We were talking just before the show again, Professor Plum, about these 5 things. For us, this is kind of this is shooting fish in a barrel, or for you, I should say. All I got is...
Well, you're pretty good at it too.
Well, yeah.
Even though you're not technically an advisor, you've been listening to us for 30 years, and some of it has actually sunk in.
Yeah, by osmosis is that's how this particular thing happens. But so I was looking at this, and I said a couple of episodes back that we would try the 5 things and maybe do it for the last 5 episodes of this particular season. We're not going to be doing this forever, but it's kind of fun, and I think let me just very quick. I'm going to give you a little background on this because I don't know if I told you. Maybe I told you how we did this. We've been getting emails for decades. I mean, since emails started, and I went back as far as, I think it was 2009. I can't remember, and found all these emails. And I mean, had to be, 1,000. I couldn't even tell you how many there were, but I can't read them all. So what I did was, this is what technology allows, Professor Plum. I was able to highlight all of them, and there were just pages and pages of them. And I dumped them all into ChatGPT. And I said, hey, can you just sort these into topics? Like the most popular topic, then the second most popular topic, and the third most. I mean, general topics. And I thought, what's it going to give me? And it did it. And what we wound up with was, well, we've already talked about 2 of them. The most popular email topic, Rick Plum, is your favorite, Social Security, which, we're not the Social Security Administration, but we do get a lot of questions about Social Security. So that was number 1. Second one was the one we did last week, which was Roth IRAs. Now, that encompasses things like Roth conversions, all that kind of stuff. So that was the second most popular topic. And so the third one, which is the one we're going to be talking about today, it was questions about 401ks. And this makes sense because I'm telling you, the most, I have nothing to base this on, but I think one of the most common investments we will have or access is through the 401k. Would you agree?
Well, that's where most people do the majority of their savings, what I've noticed. It's the IRAs are the receiving point for the rollovers, but most people build their retirement. It's normal people, obviously, we're not talking about the uber wealthy, but the most normal people build their retirement nest eggs through 401ks and pension plans at work. 457, thrift savings plan, 403b. Things of that nature. Company-sponsored retirement savings plans.
Yeah,
name them as you like.
So we did talk about 401ks. I think it was in February sometime. So a few months back, we did talk about them. But since I've had access to this, and I had said, well, on this 401k topic, I then asked the AI. I said, just give me the most popular questions, the topics of the most popular questions. And it did that as well. So this is how we come up with the 5 things. Now, I came up with like 10. So what I think I'll do is I'll take the 5 most popular things that people did not know or the things that they were asking about. And we're going to talk about them on this particular podcast, on this particular episode. So these questions, topics really come from you folks, you listeners, and listeners from all the way back to 2009. So I do think this encompasses a lot of people's questions and a lot of people's wondering about how their 401k works and things like this. So you ready to dive in here?
Let's go.
Even though I hate that term, dive in, but I'm going to dive in. All right. So the first thing, what did you not know about your 401k? Well, the first thing is that you might be able to access the money in your 401k penalty-free at age 55.
Right. The 59 and a half rule may or may not apply to the 401k. And for some, it's not 55, it's age 50. So I'll throw that one in there too. For people who terminate employment in the year they reach age 55, they can take distributions directly from that company's plan. Not any company plan, not some company you left when you were 35 and left the 401k alone there for the last 20 years, but the company you terminated from at 55 or later. You can take distributions from that company's plan penalty free. It's not an age 59 and a half, it's an age 55. And if you're a safety member, you work for a municipality, or you're considered a safety employee, then that number goes to 50. You can get to it even earlier. But the idea is in planning, a lot of times people will want to retire before they get to 60. They've been diligent savers. They've built up a lot of money, but most of it's in their 401k, or some of it's in their 401k, and they don't want to deal with the IRA rules of 72T and structured, substantial equal payment plans, structured payments, and things of that nature. So what we'll do is we'll leave enough money in the 401k to take distributions from 55 to 60, and then all the accounts open up and they can do any account. But it is only from that company that you were terminated from at age 55 or later that you can do this. You don't have to wait till 59 and a half. Now, if you take that money and roll it to an IRA, now you're not taking it out of that company's plan. You're taking it out of an IRA. 59 and a half reigns supreme. So, IRAs are 59 and a half. It's only your current employers or the employer that you terminated from at age 55 or later. And it's the year you turn age 55. Your birthday may be Christmas, and I retire in January. Heck, I'm only 50 or 49 and 2 weeks old, but I'm in a new tax year. And in that current tax year in January, it's January of the current tax year, I turn 55. I can retire, I can terminate, and I can start taking distributions because I will be 55 that year. It's not the date I turn 55. It's the tax year I turn 55 that I get to do this.
It's something that can be helpful to people. Now, this is supposed to be a retirement plan, of course. But if you do need the money and you want to take it out without penalty, I mean, there are reasons for people. It's
still going to be taxable if it's a traditional 401k.
Yeah, that particular part of it doesn't change. The only thing that's changing here is the fact that there is no penalty. Involved in that. And the penalties, I mean, what are they? They're 10%.
10%. A couple of states have a couple percent on top of that, but 10% federal is the big penalty, and it's taxable and penalized. I mean, we don't like the taxes, let alone the penalties.
Now, you mentioned the states. Is you saying some states don't penalize, or do they all also have a 10% penalty?
No, they don't. No, I don't think any of them have 10%.
But they all have a penalty of some kind.
They usually have penalties, yeah. So maybe I'd have to go back and look at all the different states.
Well,
but just understand that there's going to be penalties, and you don't want to pay penalties. No. So do your planning to avoid paying unnecessary fees, taxes, penalties, whatever you want to call it. Unnecessary expenses. Let's be efficient with our money here. Let's not pay. Of those things.
Let's not pay when we don't have to pay. All right, so the first thing you didn't know was that you might be able to access the money penalty-free at age 55. Here's a second thing you may not have known about your 401k. Number 2, your employer match does not count toward your contribution limit. Now, Professor, there is a contribution limit for just about everything, certainly 401ks. Now, 401ks are higher, as we're going to find out, or kind of mentioned here, than say, IRAs. But
significantly.
Talk about that if you would, please, the match, because there is a limit, but you can actually go over it.
Well, we're hoping that we get a match. We're hoping that the company we work for will help us save for our retirement. But there is a limit to everything, right? As John said, the money that I am allowed to defer from my paycheck, the number that I am allowed to put into a 401k or salary deferral type retirement plan is $23,500 a year this year. If I'm age 50 this year or older, I can add another $7,500 to that, so I can get it up to $31,000. So I'm limited now. The company can add money too. And in fact, in many cases, the companies will match. They want to incentivize you to save. They're trying to help you, to push you to save money for your retirement. So they'll say, we'll put in 50 cents if you put in $1. We'll put in $1 if you put in $1. I've seen some very generous matches where it's even higher than 1 for 1. That's rare, but it happens. That money that the employer is putting in does not count towards your 23.5 or the 30,000 for that matter, 31,000. So that's a separate amount that's going in. There is an ultimate high end that the combination between the two of them cannot exceed. But just count yourself blessed and lucky if you're actually running into those limits, because that means you're putting away quite a bit of money, thankfully. And the company's doing a lot of it for you. But it does not count against your 23.5. So the fact that they're putting in $10,000 doesn't mean, oh man, that means I can only put in 13.5. No, you can put in the 23, and then they put in 10 on your behalf as well. So you put in 33 that year, or whatever the number adds up to be. And matching contributions, that is part of your pay package. They're willing to pay you that money if you do certain things. One of them being saving for your own retirement. It's part of your pay package. Don't let them short you on your pay package. Get the match.
Which is something that we've emphasized just about every time we talk about a 401k. The fact that this money is yours, they're willing to do it. And I understand that there are people who say, well, my cash flow really won't allow me to put the entire amount, or at least I shouldn't say the entire amount. You're not getting a match. As far as I know, I don't think any companies give you a match all the way up to the $23,000, $500 limit. But certainly, if you can afford to contribute enough to get the full match, anything beyond that is so much the better.
It just, you don't necessarily have to meet the high end, but I think the low end is the matching contribution.
Yep. So there you go. Your employer match does not count toward your contribution limit. It's interesting the number of people who had asked about that, because it hadn't occurred to me. So that's two. Here's the third thing you may not have known, although if you've listened to this particular podcast, you probably did know it. But you may have Roth and traditional options with your 401k. And it's probably a good idea to use them. I guess use them wisely would be some advice there.
Well, it's a similar question if I can deduct a traditional IRA. Do I do a deductible traditional IRA or a non-deductible Roth IRA? If I have the opportunity to contribute to a 401k, and I have both traditional and Roth option, do I do a traditional 401k tax deduction, or do I Roth 401k no tax deduction, and then ultimately tax-free in the later years? But if it's available, those are good types of questions, good types of decisions to face, because it gives you flexibility, it gives you control, it gives you different ways to do things. And so it does become and we've had the ability to do Roth 401k since 2006. They weren't that many back then, 7, 8, 9, 10, but now they're becoming pretty mainstream. So it's relatively unusual to find a company, unless it's a really small company, that has a 401k that does not offer a Roth 401k option. Mm-hmm. And so that's just one of those things that, do I want to pay the taxes on the contribution now and get potential tax-free treatment later? Or do I want the tax deduction now? And then I'll have it as a taxable event in the future. Everybody's different. There is no one always do this or never do that. People are different. Mm-hmm. And so your decision is up to your circumstances. If you're 25 years old and you're already making a bunch of money, you're maxing out everything, you've put a bunch of money away in tax deferred accounts already, the Roth may not be the worst thing for you. It may be very good. On the other hand, if you're getting a later start, we talked about this a couple podcasts ago, I've run into a lot of people who, through whatever situation, are starting late or recovering late, or had an issue where they had to get rid of a lot of money, unfortunately. And by the time they retire, they're not going to have the ability, even if they're saving $23,500 a year, $31,000 a year, they may only have the ability to do that for 5 or 6, 7 years. They're only going to build up $250,000, $350,000, maybe even $400,000 in a tax deductible traditional form. Right now, they're getting a nice tax deduction. But when I retire, if I've got $300,000 and I'm taking out $12,000, $14,000, $15,000 a year, heck, I'm probably not going to pay any taxes, even though it's a taxable event with the standard deduction and everything. I'm probably not going to pay any taxes, so I'm getting taxed for anyway. I'll take the tax deduction today. So where you're at makes a big difference. People in their 30s, 40s, and 50s that already have $1 million in their 401ks, maybe they're going to start shifting to Roth. Maybe, but who knows? Everybody's different.
And we have devoted an episode. As you said, we were talking about Roths a couple of maybe it was last week. I think it was last week, and this Roth 401k option came up. But we've also done episodes where we talked about should you do the Roth 401k or the Roth or the traditional 401k. And because they're a lot more popular now than they used to be, these decisions, I think, are starting to come more into the forefront. I'm sure when you've talked to people, Rick, that you've just over the last maybe 8 or 9 years have talked a lot more about them than you did back in 2006 when they started.
Like I said, when they first started, or first available, I should say, the 2001 law allowed them, but they didn't actually get enacted or didn't start getting created until 2006. There were very few of them out there, so we didn't talk to anybody. Unless they were the business owner and they had the control, they couldn't do it. So we took what we could do with what we had. But now we talk about them quite often because they're more prevalent now than they used to be. They're out there. And starting this year, we can actually have our matching contribution go to Roth instead. Typically, the company contribution to a 401k, up until recently, like now, went to the traditional side. Even if I was doing a Roth 401k contribution, I'm putting my $10,000, $20,000, whatever it is a year into my Roth 401k. And the company was matching me 5, 8, 10, whatever number they were matching me. The matching contribution did not go into the Roth. It went into the traditional side of the 401k. And then when I took it out, I had to pay taxes on it because the company was taking a deduction and I wasn't paying taxes on the money going in. So somebody's got to pay taxes somewhere. Starting now, if you have a Roth 401k option and you do not want the matching contribution to go to the traditional 401k, you can direct your 401k administrator to say, no. Put that in my Roth IRA. But there's a catch. You will pay taxes on that. So if I get a $5,000 match, I'm making numbers up, your income for the year will be $5,000 higher. Your taxable income.
Yeah. Now, you said put it in the Roth IRA. You meant the Roth 401k.
No, the Roth 401k.
You want to put it in the Roth side of the 401k.
Put it in the Roth side.
As we had said an episode or two ago, there's very little distinction anymore between the Roth 401k and the Roth IRA, other than the higher limits. And of course, the 401k doesn't have quite the same flexibility that the Roth
And one
does.
difference they have is that 5-year clock for qualified distributions. They do not cut across both ways. So you may have already satisfied the 5-year qualified distribution rule for your 401k.
Oh.
And then you roll it all over into an IRA. You do not, but you didn't have a Roth IRA before this. You haven't satisfied the 5-year rule on the Roth IRA yet.
Yeah.
So even though you could take your contributions, your basis out, you're going to have to account for it on your tax return and not pay tax. It won't be taxable if you do it right. You just have to account for it. File another form. Prepare another X amount of dollars to file another form. So if you're going to do that kind of stuff, if you've got a Roth 401k and you're going to roll it over to your Roth IRA when you retire, start a Roth IRA at least 5 years ahead of when you retire. So that you've got that 5-year clock ticking.
Just start it. If you're eligible to do it, just start a Roth IRA.
$100 or whatever.
Doesn't
Put $1,000 in. Do a $1,000 conversion or something. I mean, just get it over there.
Just get in the Roth world. So, all right.
Get that clock started.
So those are 3 of the 5 so far. You may have Roth and traditional options. And here's something that we have discussed as well, but I'm going to throw it out here. The 4th thing that you may not have known about your 401k is that you can borrow from it, but that does not mean you should. Some plans allow you to take a loan of from your 401k. You can't take the whole thing. You can take like up to 50% of your vested balance, but there's a max as well. Just go over those again if you would, Professor Plum, the rules on borrowing from the 401k.
Yeah, 401ks in most cases do allow for a loan to be made from that 401k. Now, the plan, your specific company's plan has to allow for it. The law allows for it, but it has to be written into the plan. Most bigger plans allow it. The smaller plans may not, because it is a little bit of an accounting issue for the administrator. You can borrow up to 50% of your vested balance with a maximum loan of $50,000. Now, in some cases, you can change those things if you're buying a house, but most plans, I have not run into a plan that allows that yet. But it's out there. Every once in a while, you run into it. But typically, it's 50% up to $50,000. So to get the full 50, you have to have at least 100 in there. Now, the one thing to know is that when you do make a loan from a 401k, that money is no longer in the 401k and invested in whatever the investments you have. So if I had 100% of it in an S&P index, fund, ETF, whatever, and I have my $100,000 and I borrow 50 out of it, and then the S&P 500 the next year goes up 20%. My 401k account didn't go up by 20% because only at that point, only $50,000 was in that particular investment. The other 50 was in a loan to me, and I am paying interest on that loan. So I am paying money back to myself on a non-tax deductible basis, of course. It is interest that I'm paying. I am paying myself, but I don't get the double whammy of being able to stay invested and pay myself back, because that's not the way it works. But hey, should you use a 401k? We did a whole podcast on this not long ago, a year ago maybe. There are reasons to, reasons not to. I was speaking with somebody yesterday, and they are going to do a 401k loan later this year. They're putting solar on their house, and they need $30,000, something like that. And they don't have the money personally, so the only place to get the money is from their IRAs, because they have IRAs, but they don't have any personal money built up. So they were going to take a distribution this year to pay the $30,000. They're working this year. Their income is very nice this year. And if they take a distribution this year, they're going to be in a pretty good tax bracket this year. But they're also retiring at the end of December of this year. Next year, they're not going to have these big incomes. They're going to be in a lot lower tax bracket next year. So they're going to take the loan this year. Now, and then next year, they'll default on the loan. They'll make the payments through the end of the year while they're working, but then as soon as they stop working, there won't be any paycheck to be able to pay the loan back with anymore. So they'll default the loan. They'll distribute the loan next year as a taxable event next year. They'll pay taxes on it next year. So, it's fun games to play, but 401k loans have a maximum of 5-year repayment plan. So if I'm borrowing $30,000, my payment's going to be $900 a month or something, because I'm going to pay it back on a 5-year schedule. And I can't go longer than 5 years. So 50% up to $50,000, 5-year repayments must be done. And it's going to be, most of the time, they can only be done through salary deferral or salary paycheck, payments. Most plans are not set up to accept checks from you as payment or automatic deposits or anything. They just take it out of your pay. Yeah. So it's just the way it is. And right now, interest rates are in the 8 and 9% range.
Now, oh boy. Now, you mentioned something just in passing here a little bit ago on this, which was that these people are going to, you said default on the loan. Now here's what happens is, because you have to pay it back through salary deferral. You have to pay it
back. And as soon as you stop making payments, after a quarter or 6 months, they say, okay, you're in default because you're not making payments. We're going to issue this loan to you as a distribution. Obviously, you've already received the money. So all you're going to get is a distribution in a taxable event form, not real cash, because the cash is already out, of whatever the remaining balance of that loan is.
See how that works? All right. So just be careful when you're doing a 401k loan. They can work. Just know what you're getting into. That's all it is.
They're not the cheapest money. You are paying yourself back. They work really well if the market crashes while you have the loan outstanding. They don't work really well if the market goes straight up, 20, like we've had a couple of years where they did 20, 30%. Yeah, and you're limiting your growth because you're paying it back at that time, a couple of years ago, we were paying back 4 or 5%.
Just because you can do it doesn't mean you always should. Check with your financial advisor. Okay, before we run out of time, here's the fifth thing that you didn't know about your 401k. I'm making the assumption here. And you may not know this. You're likely paying hidden fees. And by the way, these administrative and investment fees can add up because they're kind of quietly deducted from your account. But over time, it can add up, huh?
Oh, very much. And it depends on how your plan's written. And it's one of those things that's like, yeah, it's a pain. And there is a cost to doing business. But does it mean I'm going to stop doing my 401k? Well, if all I can afford to save is $5,000 or $6,000 a year, I'd rather do an IRA without the fees than the 401k with the fees. But I sure don't want to give up the match. So if I'm getting a match, that helps out. Anyway, but yeah, there are fees. It costs a business money to have a 401k. There is accounting. There are lots of paper. There's legal work. There's all kinds of things going on. There's, depending upon the number of employees, there's a lot of different testing issues that go on. All this is paid for by somebody. The smaller the plan, the more likely the plan is saying, you know what, I'm going to have that built into the cost that the employees deal with. And so the internal expenses, you don't necessarily see it, but the internal expenses of the funds that are available may be a little higher to offset that fee, rather than the employer actually cutting a check for X amount of dollars per person, per participant every year to have the plan, because we know business owners don't like to cut checks. But even when you have a bigger plan, different plans have different internal fees. Could be 1% to 2% in there, or less. And so that's one thing when you're looking at fees. The more options you have, the more expensive the plan is. The more options as far as loans and this and that, with kind of lots of things going on, the more expensive, the more flexible. You want to have a side brokerage account sometimes where you can actually buy individual stocks and other things rather than just the mutual funds that the company allows. That costs money. Mm-hmm. Who's going to pay for it? Sometimes the company, sometimes not.
Well, as you said, the smaller the company, the less likely that they're going to be shouldering that burden. And it doesn't mean they won't, but it's something to be aware of. And I wanted to emphasize again what you said was there are fees in there, but at the same time, don't let that fee tail wag the dog.
If I'm not getting a matching contribution and the fees are high and I'm not able to save more than $7,000, which is the IRA limit, I'd rather have the IRA. Mm-hmm. In most cases. Now, there's always something out there that could change my mind. But if I'm getting a matching contribution, the fees aren't going to be as much as the match. So I'm still going to be ahead of the game using the 401k, even though it's high fee.
Yeah, and I mean, obviously, IRAs are a little bit more flexible, as we have said before. But one nice thing about the 401k, all this aside, is that it's generally automatic. I mean, you don't see it going in, and it winds up being
much easier.
Yeah, it winds up being kind of a passive savings account where you forget about it, and then you look at it maybe after a couple of years, you say, "Wow, hey, that kind of did add up, didn't it?" So
right, and the newer features in 401ks, like the auto escalation, I think are wonderful. Where I set it up and I'm putting in 5% of my pay. I don't know what the number is you're doing, but let's say you set up, you're putting 5%, and then you go in and say, every 6 months, raise it 1%. Mm-hmm. And automatically, 6 months later, I'm now saving 6% of my pay. And then 6 months later, I'm saving 7% of my pay. And the reality is, when you move it 1%, you're probably not going to notice much difference in your paycheck. It'll be a small difference. But before you know it, you're going to be up in the higher numbers, and you'll be like, woo, baby, I'm saving some money. And you look at your 401k statement and you say, where did that come from? I've got some money there. Mm-hmm. Making it automatic works. And then it will automatically shut off if you get to the 23.5 level or 31,000 this year if you're 50 or older. They're not going to let you save more.
Well,
just shut it off.
It's good to have. It's good to have. So before we wrap this up here, those are the 5 things. I'll just very quickly go over them. First, you might be able to access the money penalty-free, age 55 or 50, depending on where you worked. Your employer match doesn't count toward your contribution limit. Number 3, you may have Roth and traditional options. Number 4, you can borrow from it. And number 5, you're probably paying hidden fees, but that may or may not matter to you. I'm going to give a couple of quick bonuses, things that you may not have known. I just want you to do a very quick comment on this, Professor, maybe a sentence or two, nothing big. But here are some did you knows.
You think I can do that?
I don't know. I'm going to find out. Let's see. High earners, that's what I started to say. High earners may face contribution limits you've never heard of. We're talking about highly compensated employees. I don't want to get too much into this, but that can limit how much you're going to put in.
Geez, Rick, can you describe the tax code in one sentence or less?
No.
That's about what you're asking me to do.
Well, I'm not asking.
Because I ran into this just the other day. They're highly compensated employees, people that make a lot of money, and that's like 150 or above, and or the owners of the business. They may not be able to get to the $23,000 limit, even if they can afford to. There are two classes of people in the 401k. There is the highly compensated and the non-highly compensated. And the highly compensated are limited to their contribution limit based on what the other people are doing. So if you've got a lot of people that work for the company that are not contributing, one of the testing things I talked about earlier is that they have to calculate what is the average deferral of all the non-highly compensated people. So if you've got 100 employees and 10 of them are highly compensated, 90 of them are not highly compensated, and 80 of those are not contributing to the 401k, which is why they really push auto enrollment and matching matching contributions. The average amount of money that those 90 people are putting in may be 1 or 2% of the payroll, of their payroll, which means that the highly compensated can't put very much either.
Yeah. So
what happens on this person I was just talking to, they've been contributing, and then the company did the plan testing, found out that they were way over contributing. They issued them a check back. So at the end of the year, they went back and tested for last year, and they said, well, you put in your 23.5, but you were only allowed to put in 13.5 based on all the rules. Here's a check for the 10,000 plus the earnings that it did last year. And by the way, that's going to be taxable.
It sure is taxable because it should have been taxable to begin with. So I knew, see, if I throw these out at you, I know you could do another 10 minutes on that. So I'm not going to do that. But just know that
there is a possibility. So
yeah, and
it also depends on whether the plan does current year plan testing or past year plan testing. There's all kinds of fun in this.
Okay, I'll just, that's it. Rick, you're such a wealth of knowledge that I cannot stop you from doing that.
Well, you're asking me these questions, like I said. I just describe nuclear fission in one. It goes boom.
Yeah, that's what I want. That's good. Okay, last couple here. You can contribute to a 401k and an IRA same calendar year. This is true. You can do both.
It is true. The question is whether you can deduct the IRA contribution. Right. You can always contribute. If you've got earned income, you can contribute to an IRA. The question is whether you can deduct that contribution, and that depends on whether you're married or single, and how much your adjusted gross income is.
Yeah. Okay. There you go. You're just aching to say more, but all right.
I'm done.
There are a few more. We're probably out of time, but there's some good. I'm just going to throw these out. You don't even have to comment. Okay. Some plans, some 401k plans allow after-tax contributions beyond the regular limit. And if you want to know about that, go back to our episode where we talked about the mega backdoor Roth strategy, because that's really where that's involved.
And if you can afford to do it, it's pretty good stuff.
Yeah.
If not easy, because you got to be over that 23.5 ability. I mean, not everybody can save 23.5, let alone put more in.
Yeah, and your plan has to support these in-service conversions and all that. So, but yeah, potentially. You might be able to roll your old 401k from an old job into your new plan. Maybe. So that's the potential. And then there's a savers credit that rewards lower income savers. But, all right. So I won't ask you to, because
savers credit.
What? You don't like that?
It is out there, and it is something. It is helpful. It's a couple $100 here and there, but I know they talk about, $1,000 credit or this, that, and the other thing. And I remember, I haven't done it lately, but I remember looking at it to qualify for the $1,000 of tax credit, which was non-refundable at the time. And you had to be under a certain income level. But if you were under that certain income level, you didn't owe $1,000 in taxes, so you couldn't even use it. It was like so screwed up.
Yeah, it was one of those, your income level qualifies you for it, but you're not paying that much in tax, so that doesn't exist.
I'll never get the $1,000 tax credit because it's an impossibility
Yeah, they needed to rework
It's a trick question. Nobody could answer that question.
Says the person from Vinny, my cousin Vinny. It's a trick. Why is it a trick question? I knew I shouldn't have thrown that out at you. All right, so that's good. Well, those are 5 things, and those are 5 like little bonus things, and I'm sure that I could come up with a few more. But that's what this spit back at me. This is good stuff, and really, if you know your 401k, this is where a lot of people save a good chunk of their money. And if you need to know about whether or not your 401k is properly allocated, what are some of the rules? What can you do to potentially get more juice out of that orange? Well, you can talk to one of the Lucia Capital Group advisors, 800-644-1150, 800-644-1150. I think there are a couple of advisors that do kind of specialize in 401k, Professor, if I'm not talking out of turn.
With Lucia Capital Group, we have a 401k. We have a retirement plan specialist, and all this individual does is set up retirement plans and take over and talk about the fees and understand. They work mostly with the business owner or the entity that controls the 401ks. And then we have some other people who have done a lot of them as well and are used to meeting with the participants, helping them set up 401ks, doing the allocations and maintaining the allocations, and helping people manage their 401ks.
Yeah, I want to just make sure that the people understand the importance of this, because much of their retirement savings are tied up in 401k, so you don't want to do it incorrectly. 800-644-1150. You can also go online, find out more about this stuff, luciacap.com, luciacap.com. Find blog posts and videos and all this kind of stuff going back several years, as a matter of fact. We don't have, do we have a 401k guide? Ooh, now I'm starting to wonder. I don't know that there is one yet, but we're going to be working on that, I think, sometime in the next couple of months. But anyway, you can still find more information out there at luciacap.com. Don't forget to subscribe to the podcast. You can do it at Apple Podcasts and Spotify. Make sure that you download every single episode to your device and listen to it. Listen to it a couple of times, because number one, you're going to get more information out of it the second time you listen to it. And then number two, I think we get credit for a second listen. I think that adds to the number. Which,
okay.
Hey, why not? Why not? Hey, help a brother out, will you? Apple Podcasts and Spotify. Professor Plum, I do thank you for this. We're going to be doing, do 1 or 2 more of these 5 things you didn't know to wrap up the season. So I won't even tell you what the next one is, but I already know what it is. So I'm going to spring it on you right before we start the next episode. And I think you're going to be just fine with it.
Thank you.
Yes, of course. For Professor Rick Plum, Certified Financial Planner Professional, I'm your podcast host, Johnny Dean. Thanks for listening. Managing your financial future. We shall talk to you again, of course, next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. The information contained herein does not constitute an offer to sell or a solicitation of an offer to buy securities. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you're required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Examples cited are hypothetical, are for illustrative purposes purposes only, are not guaranteed and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. S&P 500 Index is an unmanaged index and includes a representative sample of large-cap U.S. companies in leading industries. An investment may not be made directly in an index. Before investing, carefully consider a mutual funds or an exchange-traded fund's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Rick Plum is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.